Hey everyone, Eric here. In this video, we're going to be talking about selling on Amazon and how to build a financial model to forecast and launch one of these businesses. We're going to break down how to forecast paid and organic sales, inventory management and purchases, cash management, meaning how do you manage your total cash, how much cash do you need, as well as scaling up your profits over time. Okay, let's get started. So for those of you who don't know, selling on Amazon, it requires like a very specific growth strategy. So they're a giant platform of basically for purchasing products. So when you launch a product on Amazon, you in general in the beginning want to buy traffic. So you basically pay for advertising on the Amazon platform to try to generate like paid sales. Even if you need to do that at a break even or even at a loss for each sale, because the point here is not to make money in the beginning, it's to accumulate reviews. Once you've accumulated a certain amount of reviews, one founder told me the amount of reviews he was targeting was like 100. You basically start to increase in the organic rankings, meaning so that when people search for your product, you start showing up organically, naturally, without any advertising. And so then they'll start clicking on your product. And without doing any advertising, they start to buy your product because they see all these great reviews, et cetera, et cetera. And from your organic sales is where you really make the profit. So it's a way to accelerate the launch of your business so that you can get into the big organic sales profit part. The one difficult thing about these businesses, sort of just in general, is that you need to purchase all your inventory well in advance of selling it. Of course, you need to order it, get it manufactured, and then get it to Amazon so that they can fulfill it for you. So sometimes you need to be cutting $10, $20, $30, $40, $50,000 checks for your inventory when you have no money. So we're going to talk about all of this, how to calculate the math, and make sure that you have got a solid business, a solid plan going into this. So we're going to look at this whole inventory management, sort of cash, P&L, everything. But first, what you always need to do when you're kind of preparing to launch a product is you need to look at the unit economics. And basically what unit economics means is what is the math on one order? Exactly the price for one order. The exact breakdown of the cost for basically one unit of whatever you're selling, the exact marketing costs, and then we're going to think about the customer lifetime value, which is for one client, do we believe that they're going to be purchasing multiple times in the future? And if so, how can we break that down so that we can understand our marketing better? So let's start here. So in my model, I'm making up a completely random product. I'm saying it's like some kind of expensive protein powder, maybe like vegan protein powder, something like that would be $89. So let's say that's what it is. Again, I just completely made that up. And so I figured out how to get manufactured, all the stuff, sent it to Amazon. And FBA is called Fulfillment by Amazon. A lot of these businesses that sort of like sell on Amazon are called FBA businesses. And FBA, what it means is that you ship Amazon your products. They're all boxed up and everything already, but then they distribute them in all these warehouses throughout the US or whatever country they're in, so that they're closer to all of the population. So someone makes an order, they can get the package to their house like within a day. And then they do all the fulfillment. So you don't have to pay a shipping company. Amazon does everything. And usually it depends on the weight, depends on the size, all this different stuff. But they're charging like 20 to 25% of revenue-ish. That's what a lot of people find for fulfilling the product. So let's say in this situation, I made up some random numbers that fall within like ranges of reasonableness. So let's say it's 2056, which is like 20 to 25% of revenue for the fulfillment. And then the only thing, they do all the fulfillment. So the only thing you need to do after is get the product manufactured. So let's say you get the product manufactured and shipped to Amazon, boxed up, everything. And on a per bottle basis, that costs $25.30. So what's your profit on one order? Well, someone places an order on Amazon, then you got to pay Amazon for the fulfillment, $20.56, and you've already paid about $25.30 to get the product to Amazon, make the product, all that stuff. So you have about $43.14 of gross profit per order. If we divide the profit by the revenue, it's called your gross profit margin. It's the percent of revenue that's profit. Okay, but that's great, but if you have no reviews on your product, no one's going to buy it. So in the beginning, we need to do what's called paid acquisition, meaning you buy search traffic. People are searching vegan protein powders, and you pay for ads so that you can show up right at the top, and you pay a premium for each click, or sometimes you pay to show the ad a certain amount of times. Depends on the platform. So we're going to break this down to cost per click and then a conversion rate to figure out how much do we think we need to pay to get one person to buy one time through our ads. So again, there's a lot of calculators and research that you can do on certain products, niche products. And so you can actually figure out the cost per click, or sometimes the cost per 1,000 impressions, meaning like showing your ad. But let's say we did our research and cost per click in this situation is $3.10, which is quite high if you compare it to Facebook or Google, but Amazon has a very high conversion rate. So you don't need that many clicks to get a purchase. So let's say in our situation, we did research and vegan protein powders have a conversion rate of 7.5%. So again, if you have a regular e-commerce website, a typical website is going to have like a 2 to 3% conversion rate. That's considered like pretty good. So 7.5% sounds ridiculous, but Amazon site-wide has one of the highest conversion rates of any websites in the world. It's around 10% supposedly. So that means that every 1 in 10 people that goes to Amazon.com buys something. So basically what it means is that it's very high intent traffic. It's literally just a search engine of products to buy. So when people are searching for a product, if they search vegan protein powder, they're trying to buy it usually. So you see extremely high conversion rates. Again, you'd need to research the conversion rate because I think conversion rates probably can be lower, maybe 2, 3, 4%, and probably really, really high for really random niche items too. It could be 30%. So you need to figure this out. But if you can get these two numbers together, all you do is you take the $3.10 and you divide it by 7.5%. This is the shortcut way of saying like how many clicks at $3 do I need to get one conversion, just mathematically shorter. And it's $41. You need to pay $41 of clicks to get one person to buy. So if we think about what's our profit on one order, so we made $43, but we spent $41 to get that order. We only made $1.81. So it sounds kind of bad, but with these businesses, like I said in the beginning, the point is not to make money on your paid orders, it's to get reviews. And so you can even turn a loss on these orders because the reviews are worth way more than, some small losses. Next, you just want to think about, for instance, if your strategy is mostly paid acquisition, how many lifetime orders do you think you'd be getting from one customer? So if it's a consumable product like protein powder, probably people are going to be buying it a few times. Maybe your typical customer, maybe you have the product launched on another platform and you say, wow, if I look through all the emails, on average, my typical customer purchased 2.2 times. If that's the case, then you basically make this $43 of profit 2.2 times. And so when you get one new customer to buy, you don't make $43. You make $43 and then you make $43 again. But on that second time, you don't do any marketing because they're just coming back because they like your product. And then in our situation, another 0.2 times on average. So you end up making about $95 of profit. And of that profit, you spend $40 on marketing. So you're still making a profit on these people over their lifetime, even if it's not on the first order. And finally, there's a quick ratio, which is the lifetime value to the CAC. And again, the CAC is just how much do you spend on marketing to get one person to buy for the first time? Lifetime value divided by CAC, 2.3. So you know that, your lifetime profit is much more than your marketing. And so even with your paid acquisition, probably going to make money on your customers. But now let's jump to our income statement because we know that our paid acquisition strategy seems solid. So how much of this do we need to do until we can get enough reviews so the organic people start buying? How many products do we actually need to buy? How much inventory do we need? How are we going to finance it? Let's jump into all of that right now. So first, what I'm gonna do is I'm gonna just hide these rows, and then I'll go here, click View, Freeze Panes, so that when I go down, I don't lose my months, and when I go to the right, I also don't lose my columns. Okay, so what's the starting point? So with e-commerce businesses, the starting point is always marketing, because you have an assumption of I need to spend X in marketing to get one order. So let's go down here and we go to our marketing budget. So this is what we're going to spend on Amazon, the platform, to try to kind of get people to buy. So marketing budget, let's say it's $1,000. And then let's say in month 2, it's $1,500. And then from there on out, our plan is to spend $1,000 more each month as we grow this thing to month 16. Okay. And we know what our CAC is, customer acquisition cost. We already calculated it. We believe that it's going to be $41. I just tapped F4, which locks the column and the row. So now I will be able to copy this formula. And so how do we figure out how many paid orders? And they're called paid because they come from paid acquisition. Hit equals round, because I want to basically have a whole number. No, it's not a decimal because it's an order. I take the 1,500 in marketing and divide it by the per order marketing cost. So that gets us 36 orders. So if I spend $1,500 and it costs $41 to get one order, I get 36 orders. So simple as that, nothing too crazy. And so this now will tell me how many paid orders I can sort of get. But when do the organic orders start? When do we start ranking, and how do we sort of relate the paid to the organic orders? And a really simple way to do this is create like a paid to organic ratio. So let me just kind of do this math, and I'll explain to you how it works and why this is sort of just a really easy way. So here I'll have our paid to organic ratio increasing over time. So in this situation, again, I'm going to do round because I want a whole number. I'm saying we get 24 paid orders times 10%, get the whole number. So we get 2 organic orders. And so this basically shows us sort of the ratio of paid to organic. So if I put this number at 100, it would mean if we get 24 paid orders, we get 24 organic orders. So to start out, I'm saying we only get a couple organic orders. This is probably like your mom, your friend, like nobody's finding your products on Amazon yet. But later on, like customers that you don't know will start to buy your product. So our total orders are here, paid plus organic, 26, right? Okay, so now we have an order forecast. And the idea here is that I just have this number increasing 10% a month because, after 4 or 5 months, now you've got 300 orders. So probably you're starting to accumulate some good reviews and your product is kind of creeping up the ranks on Amazon. And so at the end, if we increase this 10% a month, et cetera, we get it to a point where it's, you have more organic orders than paid orders. Again, by the way, you can just download this model for free in the description below. Change it. Could be that this number is much higher, much lower. I don't really know, but it's a good framework to start with. So now that we kind of have our orders, let's figure out kind of what we need to do in terms of inventory, because inventory is tricky. So let's say we put our life savings in and we bought 250 of our protein powders. The way I calculated this is I took 250 and I multiplied it by the per unit product cost, $25. 250 times $25 is $6,300. And let's say that we had $1,000 more dollars, and that's the business's starting cash, and that's after purchasing all this inventory, right? So how do we think about this? Well, here's how we do it. For inventory, let's say there's a 4-month lead time. So if you do an inventory purchase, let's say then you need to wait, and then you have an inventory arrival. So I'm saying like you're in month 2, it arrives in month 5. So that's kind of 4 months later. And so I just did an equals sign and did it like that. And now I can just basically copy this formula over, no problem. And this will basically just show me when the inventory arrives. So I have the total inventory here minus anything we sell plus any inventory that arrives, right? Pretty straightforward. So if I copy that over, you'll see, our inventory is going down, but our 500 units arrive, and now we've been replenished, and so we're back. So I'm going to copy this formula, and I'll show you how this can help us to kind of anticipate our inventory. So these negative numbers it means we're out. We can't go negative. So what you're trying to do is never let your total inventory go negative. So if we're here, we see, wow, just 2 months later, we're basically out again. So let's say we buy another 500, right? Okay, 500. And then let's say here, we need to buy another 1,500. A lot, right? And then over here, let's say we buy, 2,500. Let's see. No, I think we can do a bigger one. Let's say we buy like 4,000, because now we're really kind of cranking it up, and we don't want to run out too quick. So that's our inventory. But I mean, if 250 units cost us $6,000, you can imagine that 4,000 units is going to be a ton of money. So now we need to basically forecast the income statement to try to figure out our cash, so that we can figure out how short we are when we sell these products. So let's go up and do that, and then we'll kind of look at our cash here, and then I'll kind of talk about how we might be able to do that. And so first, the one thing I just want to do to kind of start it off is inventory investment. We've got the numbers here. It's 500 times the cost of 1 unit. I hit F4 to lock the column and the row. And so, yeah, that's going to be 12 grand. And yeah, we've got all this information. So we're going to have to be, this is going to cost 12 grand, 13 grand, 13 grand. This is going to be 40 grand. That's going to be $100,000. Where on earth are we going to get that money? So let's see how much profit we're making to see, do we actually generate enough of profit so that we can calculate our cash. And by the way, if you're enjoying this video, I noticed that only 10% of people that watch my videos actually subscribe to my channel. So if you could please subscribe to my channel, like this video, leave me a comment down below, I'd really appreciate it. And you won't miss any of my new e-commerce, finance, or digital marketing videos. Okay, so let's keep cruising up to the top and start calculating. So total orders, we already know what that is. We calculated it here. So we've got our total orders, and we can just kind of copy that over. And then you've got net revenue. So that's just your orders times your price. Lock the cell. Now we know what our sales are. Okay, and that's great. So let's take it to month 6. We'll copy this over in a minute. And then we've got our Amazon fulfillment. So we know that that's just 26 times Amazon fulfillment fees per item. Again, that's going to be ramping up with our orders. And then here we have the product, and I'm calling this basically our inventory financing. So if we go down below, you could put in $23 times the orders, but that's, as a founder, that's not how your cash is actually going to work. It's going to be all your cash is going to go out 1 month, and then you're going to wait a few months, and then all your cash is going to go out again. So you really need to look at this inventory investment line. So that's kind of what's happening with your dough. So if we look at that, your sort of cost of goods sold, which is just your product costs, are actually going to be pretty crazy. So if we look at what's your gross profit, it's your revenue minus the costs of fulfilling and buying your products. So if we look down below, take the gross profit divided by the revenue, this is the percent of revenue that you're basically turning into profit. And again, with all these inventory purchases as you scale, it's going to be pretty crazy. And so advertising, we have down below. We put it in the budget each month, just link that in. And then your post-marketing profit. So that's your product profit minus your advertising. So all that work, and you only made $799. And the profit percent, technically that month is positive, and then the other months it's negative. So I'm gonna just copy this forward a little bit, just kind of through the end, so that we can really figure out how much cash do we need? Like, do we even have this cash? Because look at these, months. So here's how we're gonna do it. We're gonna take our starting cash, just add the profit to it, because this is our profit after we did the financing and everything. And so what you'll inevitably see is that we run out of cash. We have no cash. We don't even have enough cash to get to month 2 because we need to buy inventory that arrives in month 5. And we don't have, we're negative. We don't have money here. We don't have any money. We finally start getting some money back, and we go negative again. So, it's just really, really tough to manage businesses like this. And so one thing I want to bring up is that in the last couple years, a bunch of different businesses have kind of been started which provide alternative financing to early stage founders. So before these businesses came around, the only option that an early stage founder had was to basically just go and sell equity in their companies in the beginning, like huge chunks of equity. So they had to sell permanent equity in their companies to finance inventory purchases that they'll just resell a few months later. So you sell, let's say you have your company for 30 years, you sell 30 years of ownership so that you can finance your inventory for 3 months. Honestly, it's absurd. And so a couple companies have come along that do alternative financing. And in terms of inventory financing and marketing financing, where they'll give you some money up front, but they'll do it non-dilutively. Basically, the biggest and most legit company that currently does this, and it's actually like the only one that I've worked with across a bunch of different startups, this is before I started YouTubing or anything, is called Clearco. It used to be called Clearbank. I don't know if you've heard of them, but they do inventory and marketing financing to early stage businesses, but non-dilutively. So they don't take any equity. So let me just kind of show you their website really quick. So what they basically do is they just buy your inventory for you. You say, look, I don't have enough money. I need $30,000, and they'll buy your inventory for you. And then when it arrives, let's say a few months later, and you begin selling it, you just pay them back a percentage of your revenue. So let's say 30% of your revenue plus a flat 6 to 12% fee. And it's flexible, sort of the payback, but it basically just allows you to grow your business non-dilutively. They lend you the money, you pay it back in this sort of revenue share way, but they don't take any equity. So it's really great for founders. There's another business called Pipe that does this with recurring revenue for SaaS businesses. And what Pipe does is if you can basically say, look, I've got these customers on this 12-month contract, it's this marketplace where people will lend you money as long as you give them the right to that recurring revenue. So this is kind of a similar thing, inventory and marketing financing. And this company's legit, Clearbank, or Clearco. I think they financed around $2 billion to like thousands and thousands of e-com startups. So they're definitely like the first mover and the big one. And the way you apply, it's pretty easy. So marketing capital, inventory capital, you basically just connect. Yeah, you connect your apps. So you connect your Shopify and whatever, and they give you an offer in 24 hours. And they fund you within 3 to 5 days, and then you just figure out a flexible way to pay it back. And I included a link in the description below. If you use my link, you'll get a $500 discount if you use their services. So, that's a pretty nice discount. So I would love if you could check it out. And I think the only requirements are that you need to be an e-commerce or a SaaS business, and you need to have 6 months or greater of $10,000 of monthly revenue. But these guys will cut pretty big checks. And if you have less than $10,000 a month, they actually have another program. You can check it out and get funded, which is called Clear Angel. And they make smaller investments like 10 to 25K, but you only need to have $2,000 a month in monthly revenue. And in that situation, it's not the same payback. They basically just take 2% of your revenue for 4 years, but no equity. So you don't have to get the VCs involved in the financing of inventory or early stage marketing, and you can just pay it back. So really, really cool, enabling founders. I love this ecosystem, and this is the company that I've basically mostly worked with. So take a look if you're kind of getting stuck in this world and trying to figure out how you're going to finance it. So now let's go to kind of building a model around a financing like this that's like a revenue share, and I'll show you kind of what that would look like. Okay, so we're here in this situation, right? Our cash keeps going negative, but we say, wow, I can go to one of these businesses and do an inventory financing. Now what does my model look like? What could I afford? So in this situation, what you would do is this sort of inventory row, you just kill it, because now they're going to be giving you all that money up front. You don't need to worry about that. And instead, there's going to be like a revenue payback. So here you go. They finance here in month 2 inventory that arrives in month 5. So they won't make you pay back until you can start selling the inventory. So how it would work is you would just take your revenue, you figure out the terms with them, but this is the kind of thing that it looks like, and you would just pay back like a revenue split, and I'm saying 30%. And look, you can pay that back and be profitable. And let's say you paid back 30% every month. And again, they would put a flat fee on top total. So that'd go into your total you need to pay back. So let's say if you're doing that, you paid back $160,000. Well, how much did they finance for you? And first off, let me point out that now you're never going negative on your profits. Every month you're turning a profit. Your margins are smooth. You're building up your cash. And total, they financed $164,000. So between month 5 and month 16, you'd pay back $160,000. So it could be that you're just basically you're basically paying this off just 3 or 4 months more, or you continue to work with them. But you can see, if you can finance it like this, you never need to raise growth capital. You can just continue to own 100% of your company with a revenue share like this. So I would really encourage founders to look at, Clearco. Pipe is another one, particularly for SaaS businesses. And there's a whole ecosystem getting started of businesses that are doing financing of marketing and inventory for founders to keep them from having to sell a bunch of their company early on, because it's really not good for them. So that's it for today for this model. I hope now you have an amazing understanding of how to build models for these businesses, these FBA, Amazon FBA businesses, or selling on Amazon in general. And I also hope that you learn some things about inventory financing and what options you might have where you can do something non-traditional and really take advantage of some of these other startups that are providing financial services right now. So by the way, in the description below, you can download this Excel file completely for free if you want to use it for yourself. I've also linked down below to some of my other financial modeling videos. Check those out. And if you found this content valuable, please subscribe and click the little bell icon. Like this video, leave me a comment below, and also check out some of my online programs if you want to do more finance or e-com training with me. It's all for today. Thanks for watching, and I'll see you in the next video.